South Africa's economic growth slowed, and I suppose that's relevant to what we're talking about in the first quarter of this year, hit by a sharp contraction in mining, but manufacturing showed surprising resilience. The economy grew by 2.7% quarter on quarter on a seasonally adjusted and annualised basis, and that surpassed analysts' forecasts of 2.4%, compared with a 3.2% rise in the fourth quarter of last year. Now, for more on that, Matthew Sharratt, economist at Merrill Lynch, joins us from our Cape Town studios. Hi, Matthew.
Good evening.
Your take on the GDP numbers. It seems to have been better than expected.
Yeah, I think we were one of those analysts that were surprised pleasantly by the data. It did come out somewhat better than the consensus had thought, but I think the bigger picture, if we stand back, is that we can hardly say that the data is shooting the lights out, and I think the clear picture is that momentum has actually slowed into the first quarter of this year after a reasonably good recovery late last year. And I don't think it really changes the picture for the Reserve Bank for that reason, given all the downside risks to the global outlook that we face currently.
Matthew, against this backdrop, how do you see the rest of the year? You know, what will our GDP be for, where do you see it for the year? And I say this because I think last week we had Jill Marcus saying that growth next year is going to be something like 3.9%, the year after 4.5%. You know, where do you stand in your forecasts?
On the growth picture for next year, you know, we also relatively optimistic outside of a major shock coming from Europe. So we would tend to emphasize a lot of the domestic demand drivers for growth, particularly the potential for the government to boost growth via infrastructural spending. But I do think that you know, in the current environment, looking at a growth rate of 4% for next year, I think clearly the risks are skewed to the downside, and we really have to see just how the Eurozone story plays out.
Matthew, I mean, you look at the other numbers that are coming about and this continued nervousness about Europe and how exposed we are to Europe. The credit numbers out, the credit health from TransUnion, their survey saying that the index is down from 54 to 50. Below 50, it's in more dangerous territory. So there are a lot of reasons why GDP won't grow by more than this.
Yeah, I think that's a great point. You know, despite the data today surprising to the upside, I think this 2.7% we saw for the first quarter is pretty much going to be the run rate for this year. Our view at Bank of America Merrill Lynch is that we get a 2.8% overall GDP number for this year. And I think the biggest worry for me is really what's happening in the retail space. I think part of the weakness that we had anticipated in the GDP numbers was that retail spending on a trend basis went into reverse gear in the first quarter, and I think that reflects some of the pressures facing the consumer side. I think one of the interesting dynamics within the consumer space is, as you pointed out, the unsecured credit, which I think, at least on a near-term basis, is providing some support. But on a longer-term view, you know, I do worry about the sustainability of the unsecured credit numbers that are coming through. But, you know, moving away from there, if you look at the PMI for the manufacturing sector, yes, we had a nice rebound from late this year into early this year on the actual data in the manufacturing sector. But I think the manufacturing PMI gives us a warning that some of that momentum is already slowing. And again, it comes back to the Eurozone story. If that proves to be something of a global shock via a Greek exit, it's very difficult to make a call at this point. That will have knock-on effects for our growth. And I think we could have considerable downside risks to the growth profile for South Africa.
Actually, there seemed to be a bit of a contradiction, and I think David was nodding his head there. We've just been talking about the strong retail numbers.
We were looking at Foschini's results and trying to find the connect between the results there and GDP. And you mentioned unsecured loans, you know, in other words, the huge increase in unsecured lending. Do you attribute the kind of retail demand that we're seeing to that area of the market?
Well, I don't think it's solely down to the unsecured lending data, but you know, we have done, you know, some statistical work on it, and clearly it is you know, a positive factor in boosting spending. But I think it's, you know, it's quite clear from what we saw in the first quarter, the Stats SA retail sales number on a quarter-on-quarter basis, they declined by just over 1%, and this follows some very robust spending in the third and fourth quarters last year. So Retail sales did come under some pressure in the first quarter. I think when you look at the GDP category of wholesale and retail, which includes the motor sector, yes, we saw some expansion there. But on the actual activity numbers, we did see some pressure on retail spending in the first quarter. So I think there is something about a slowdown relative to very robust spending numbers we saw in the second half of last year. I would put that down to pressure on real disposable incomes and potentially some very mediocre job growth.